Projecting working capital balances. We can use working capital metrics to project future working capital balances. This lesson explains how to do this. Here is a statement of cash flows from a public company in which I've stripped out the name of the company and the date. Notice that many of the adjustments to get from net income to net cash from operations are changes in working capital accounts. The lesson on the cash conversion cycle also showed cash flowing into and out of working capital accounts. The cash flow statement has many other line items which show the broader picture of cash flow management. Thus, effective working capital management increases cash flow and profits, but cash management is much broader than working capital management. Please take my Managing Cash Flow course for a deeper dive into cash flow management. The working capital adjustments made in backward looking cash flow statements are very useful for making forward looking cash flow projections. Forecasts and budgets are often driven by sales projections. They are often based on accrual accounting. We need to translate that to a cash forecast for cash flow planning and to create the financing budget. It also helps us estimate inventory purchases for operational planning. It will also help us project the accrual based accounts receivable, inventory, and accounts payable balances. Let's first start with a very simple example of the importance of managing both accrual based profit and cash flow. It shows how the lags in the cash conversion cycle cause cash to drop before increasing when a company has the opportunity for massive growth. Companies that aren't prepared either have to pass on the opportunity or jump on it and then run out of cash. Let's say you built 100 widgets at a cost of $80,000 and sold them for $100,000. Congrats! You just made a $20,000 accrual based profit. Now let's assume that you paid for the cost of goods when you ordered them. Your invoices to customers said their payment was due in 30 days. Your cash flow for your first month during production is negative $80,000. The following month, you receive the payments from your customers, so your cash flow spikes up by $100,000. That dip, followed by a spike, may not be a problem for a small amount. If you had a shot at a $2 million profit opportunity, could you find $8 million to pay for the cost of goods to capture it? Feel free to add as many zeros to my question to scale it to the size of your company. We will now walk through an example using a company called Jack's Beanstalk Beans. You may remember the story of Jack and the Beanstalk. Jack trades the family cow for magic beans. These beans grow overnight to a massive beanstalk that reaches into the sky where a giant lives. Jack steals from the giant and then kills the giant as the giant chases after him. It's not every night that you soothe your child to sleep with a tale of theft and manslaughter. I'm going to show an example of how to convert the gross profit for Jack's Beanstalk beans from an accrual basis to a cash flow basis. I roll the balance sheet items to show the activity in them for each month. The cash flow can be derived from rolling these accounts or can be derived via a formula, which I'll also show. Jack has estimated the following number of days for his cash cycle. Days sales outstanding are 45 days, days inventory outstanding 60 days, and DPO of 30 days. Since cash from sales are collected after the sale, we must go back in time to find out the sales in the past year that we will collect in the current year. Jack's sales in the last quarter of the previous year, so Q4 XO, were $120,000 or $40,000 each. For all calculations in this example, we will assume that each month is 30 days long rather than the actual length of 28 to 31 days. This is a valid assumption if transactions occur evenly throughout the month. If all your sales come on the last day, you may need to use actual days and may want to project cash on a weekly basis. This uneven cash flow can create big cash timing issues. Here's how the cash from sales and the accounts receivable balances are calculated. The calculation starts with sales. In November, all that's in accounts receivable in this example are sales. In December, Jack books another $40,000 of sales, but also receives half of the November sales. Remember that cash is collected 45 days after sales. The sales from November 1 to November 15 are collected 45 days later in the last half of December. In January, enough time has elapsed that we can fully roll the balance. January sales are $50,000, which I showed in an earlier table. In January, we collect the last half of November sales and the first half of December sales. The formula is November sales times 15 divided by 30 days plus December sales times 15 divided by 30 days. January's ending AR balance is the beginning balance plus sales minus cash collected. You can calculate the ending balance directly using the 45 days of sales outstanding. The formula for January would be December sales times 15 divided by 30 days plus January sales times 30 divided by 30 days. If the DSO was 75 days, the formula for January would be November sales times 15 divided by 30 days plus December sales times 30 divided by 30 plus January times 30 days divided by 30 days. Adjusting the cost of goods to cash paid requires two parts of the cash conversion cycle: days inventory outstanding and days payable outstanding. We can also track the balance for inventory and accounts payable. To roll inventory and accounts payable, we can track when the inventory cost of goods was purchased. Jack's days inventory outstanding is 60 days, which equals 2 months. The second image of this slide shows that the $30,000 cost of goods expensed in January was purchased in November, which is 60 days earlier per his days inventory outstanding metric. Now let's roll the inventory balance. The timing of inventory purchases and cost of goods from the middle image are in the second and third lines of the bottom table. Each column of the inventory roll is calculated as beginning inventory plus inventory purchases minus cost of goods sold to arrive at ending inventory. Jack's days payable outstanding is 30 days, which equals 1 month. In other words, Jack pays for inventory 1 month after receiving it. This allows us to roll accounts payable. In this table, Jack pays $30,000 in December for the $30,000 of inventory he bought in November. The inventory purchases come from the inventory roll image above. Each column of the accounts payable is calculated as beginning balance plus inventory purchases minus payments to arrive at the ending balance. Using the tables I created earlier, we can now calculate the cash received from sales less cash for inventory for our cash budget. This is what it would look like for the budget year summarized into quarters. The cash collected from January, February, and March totals $135,000 for Q1 cash from sales, and the payments of January, February, and March totals $93,800, which equals the cash paid for inventory for Q1. An alternative way to budget the timing of cash received from accounts receivable uses the percentage of credit sales that are received each month. Likewise, you can budget the timing of payments on accounts payable using the percentage of credit purchases that are paid each month. I'll show an example of using accounts receivable. In this calculation, Jack receives 50% of sales the month after a sale and the other 50% 2 months after the sale. This tells us how much is left unpaid, in other words, still in accounts receivable each month. The right side of the example calculates accounts receivable at March. At March, Jack has received all of January's sales, but has only received half of February's sales and none of March's sales. The monthly sales of the past months are multiplied by the percentage unpaid at March. The total of each month's sales unpaid is the AR balance.